Hey there, it's Casey Dimon here from TaxSaleAcademy.com, and I got another question I want to answer in today's video. Before we get to that question though, if you enjoy these free tax sale training videos, please do me a favor and let me know by clicking that thumbs up button just below this video. And also, don't forget to subscribe to our channel. That way you don't miss out on future tax sale training videos. Today's question comes to us from Ricardo. Ricardo says, new subscriber here, when buying tax deeds, what happens to those liens? First off, Ricardo, thank you so much for subscribing to our channel and also for submitting your question. So for all of the new viewers or the viewers that don't understand or don't know what a lien is, it is basically a statement of claim against a parcel of real estate. A common example of this is a mortgage lien. The mortgage company or person who loaned money against that real estate has a claim to that real estate in the event that's ever transferred or sold. The same can be said for, say, a mechanic's lien. If you fail to pay somebody to perform work on your property like a plumber, they could place a lien and have a claim against your property for what you failed to pay them for. Now you can get that lien off by paying it and recording a satisfaction, or by suing to get the court system to remove it for you. Now when it comes to tax deed sales, liens are going to be handled just a little bit differently. In most tax deed states, a tax foreclosure will take priority over all other liens. This means that that tax foreclosure is going to be more important than any other liens involved, such as a mortgage lien or a mechanic's lien. So in a tax foreclosure, those liens are going to be extinguished as the property goes through that tax foreclosure. So here's what must happen. In that tax foreclosure process, the lien holder must be notified in most states. This means that the county will send out a notice to them to tell them, hey, you're going to lose the interest that you have in this property because it's going through tax foreclosure. It'll also give them the option to pay the taxes off. That way they can protect their interest. This is actually pretty common amongst a lot of mortgage companies. So if you've loaned $100,000 as a mortgage against a piece of property and the taxes are just $2,000, what they'll do is they'll simply just pay those taxes. That way they can protect their interest in the property. Then they'll add that to the principal according to the terms in their mortgage, and then the homeowner is responsible for everything, of course. It only makes sense that the county must give the lien holders an opportunity to protect their interest. Now, if the county fails to do this step, there might or might not be grounds to fight that foreclosure after the fact, depending on how the laws are written in your state. So these private parties liens generally will not transfer from one person to the next after the tax foreclosure. Now, when it comes to governmental liens, it is different. It doesn't make any sense for the government to write laws that will allow them to cancel their own liens. It just does not make sense, doesn't add up. For example, if there's a $5,000 lien for county fines, the county isn't going to just say, well, the property's in tax foreclosure now, so we aren't going to be worried about that $5,000 anymore. Instead, those government liens, such as liens for code violations, demolition liens, repair liens, water, sewer, electric liens, any liens that are held in the county's name or the city's name will in fact stay with that property, and those will become the responsibility of the tax deed buyer, who can pay them, or they could try to negotiate them down or off completely. Now, another type of lien is an IRS lien, which will stay with that property for 120 days before it will automatically come off. During that time, the IRS can reimburse you for the property and take that property. So many people worry about this, but it's actually very rare for the IRS to step in and take a tax sale property. Now, as with everything, it's extremely important to take the time to review your state's laws, determine what will stick, what won't stick, and know what you're getting yourself into before you take possession of an unexpected bill after you buy that property. So, Ricardo, hopefully this helps you out. If you have any other questions about tax investing, or anybody else watching this video has a question, feel free to leave them down below in the comments, and I'll definitely answer them. I might just shoot a video like this one. If you are looking to learn more about investing in tax-defaulted real estate, there's a whole bunch of links down below in the description. You can also head to TaxSaleAcademy.com where you get your copy of my book, Tax Sale Playbook. The book itself is free. Just cover the shipping cost, which is nominal, to get it from our warehouse to your front door. It's actually probably less than you paid for your coffee this morning. And of course, if you're ready to go all in and take our step-by-step comprehensive training that will guide you from A to Z when it comes to being a successful tax sale investor, just head on over to the same website, TaxSaleAcademy.com, and click on Join. Take care. Bye-bye.